taking the time to define what are the right kind of people that you need in your company, what's the behaviors that are successful, what are the core values that are successful. If you recruit people right the first time, your turnover goes way down on the back end.
Hey, Steven, glad to have you on the show today.
Hey, Spencer, thanks for having me.
Yeah, I'm excited for the conversation because I think you're going to bring a wealth of knowledge to some critical business topics, which we'll get into. But I always think it's helpful just to get a little bit of background, on your journey into kind of what you're involved with now.
Well, I'm unusual. I started as a accounting clerk for my dad when I was 12. And they put
started young.
Yeah, he got a Texas Instrument calculator, which automated the process of adding up the outstanding checks. So I didn't have to manually do it anymore. And I thought, wow, this is so much easier. And in 1979, I worked in a CPA firm as an intern, and they put a Apple II PC on my desk, and a computer junkie was born, right? The start of PCs. So I combined this passion for small business accounting and technology to help them use accounting to make more money, to increase their profitability. So it's really it's been very rewarding to teach that to others.
Yeah, that's awesome. And it's funny, even just that language you just used there, you don't often hear that in accounting. A lot of times when you think of accounting, you just think, oh, it's the numbers. I got to do these statements for my CPA and all this stuff. But you said you like to use the numbers to help people make more money.
Yeah, I'm a CPA. I've been a CPA 36 years. I've been on the executive board of the Houston CPA Society, and I'm proud to be a CPA, but our whole industry was designed for compliance. It was designed to look backwards. In fact, when I was at Ernst & Young, they taught you can't audit something in the future, so never prepare a forward-looking statement. That's how I grew up, and that's what the industry is designed for external users, right? The traditional income statement is designed for helping businesses be in compliance with the bank, be in compliance with the IRS, be in compliance with an auditor. And that's financial statement is like the box score of a baseball game, right? It's like what happened last night and just the basics. Who won, how many runs, what inning, maybe how many errors and how many hits, right?
Yep.
What I love is the management accounting, which is Billy Ball. It's Moneyball, right? It's how do you make decisions on a day-to-day basis to be able to figure out, do I bring in the lefty or the righty? Because the roof is open and we're on artificial turf and it's 77 degrees or higher. In business, it's about understanding what are the decisions that you have to make in order to drive profits. And then what's the drivers of those decisions? And then only then can you figure out what reports do you want to have at your fingertips. So
yeah, that makes sense. So I like that analogy of, the baseball, and thinking, okay, do I use the lefty righty? Like what kind of turf are we on? Like which field? How does that play out when you're thinking about your business? What are those data points that you're looking at to try to work on profitability?
There are three that really matter. Most business owners think they can sell their way to profits.
Yeah, I hear that a lot. People say, "Oh, I just want to double my business, and that'll solve everything."
Yeah, you do lead generation and marketing, right? And you're trying to help people grow their top line, and you need to grow your top line in order to be able to grow your bottom line. But your percentage of growth will not change unless you do number two, which is gross profit percentage. So to my mind, the most important data point of any business is their gross profit percent. Why? It's why the Shark Tanks, right? The sharks will always ask you, how much do you sell it for? And then how much does it cost fully landed? They're doing a percentage calculation in their mind. It's like, okay, if you're making a 40% margin on this, then I understand how many units of can I move to see how we make money on this. And the reason that top line revenue is not the most important thing, and bottom line net income is the most important thing, because gross profit causes net profit. Every additional dollar of gross profit you bring in goes right into the bank account, goes right into the profit line, is assuming that your overhead is not artificially growing. So, and so that's the first is top line revenue. The second is gross profit percent. And then the third is overhead. How much does it cost you to run, to have lights on? What's your nut? How do you make that variable as much as possible? Because fixed overhead hurts. And now with COVID and space being a whole different thing, it's so much easier. But the idea of converting whatever you're paying in the back office, your IT costs, your HR costs, your accounting costs, and as much as possible your sales and marketing costs, make it variable, so that if you hit downturn and revenue goes down, you're not stuck trying to absorb all these fixed costs. Does that make sense?
Yeah, absolutely. And yeah, it caused a lot more thoughts and questions we can dig into. So let's maybe skip to the second point. You said obviously growing top line is important, but that second point you said was almost like your number one, gross margin. So for some basics, how do you calculate that? If somebody's running a remodeling business, a lot of our listeners are remodelers or custom builders, what kinds of things are they thinking about to calculate that number there?
This is the one industry I have spent more time working on than anything else in my career, because my parents are both off the boat from Ireland, okay, settled in New York, met in the Bronx, got married, had me, and and I was the firstborn American in a large extended Irish family, and all my relatives, at least on my mother's side, the Gilrains, were contractors, were carpenters, were electricians. My Uncle Eddie spent years putting the ceiling in the World Trade Center. So when I started my CPA firm after Ernst & Young, I focused on construction business. And it's like any other project-based business. You have to understand the above the line versus your below the line costs. So what is gross profit? The math is your total income minus your cost of goods sold, the cost to deliver on your services. And there's only two parts to it. They're both direct costs, meaning the definition of cost of goods sold is it's the direct costs that your customer paid for. It's directly what the customer is buying. Without that cost, you would not have earned the income. That makes
sense. Yeah. So it's going to be materials and, so because you wouldn't have bought the material unless you sold the job.
That's right. There's two types of cost of goods sold. They're both direct. Direct labor, which is the people that you paid to do the work. And it doesn't matter how you paid them, whether they're subs or they're full-time salary or they're paid by the hour, it's labor. And if it's the labor that you're billing your customer for, then that goes into direct labor. The other is direct materials, the stuff you had to buy, the sheetrock and the 2x4s and anything, whatever it is. If you can't serve the customer, it has to go above the line. And what that does, it shows you what does it really cost you to deliver your services. One of the biggest mistakes I see is people, they don't allocate. Labor costs are your biggest expense, a controllable expense, right? I'm talking to a construction company tomorrow. It's 52% of their expenses. So it's the biggest expense they've got.
Mm-hmm.
And all the payroll is below the line in payroll expenses. Why? Because that's how the accountants set it up, because that's what you need to do for the tax return. You need total payroll expense so it can go on line 37. It's about compliance.
Not helpful from a business perspective.
Not at all. It's not designed to be. So the allocation of the labor is the first step. And it's there's a couple of tricks here. First is you have to, if they're all subs, it's easy, right? They just go in. Yep. They go into labor. subcontracted labor, you can separate from some salary if you have salary. The subcontractors are also easy because it's a total amount. Where a lot of people make a mistake is they just, for the people that are on payroll, they just do the salary and the taxes. And you got to look at the fully loaded labor costs. So if you're covering any health insurance, if you got recruiting costs, if you got training costs for those direct laborers, it goes with them. Because what you want is, the most important lesson that I've learned over 36 years is the best run companies have a human capital strategy, a people strategy, and a financial management strategy, and they work together. And the biggest hidden cost in a business usually is turnover. So when somebody walks out the door, we're all run by tribal knowledge. Remember, the tribe leaves, so does the knowledge. So
yeah, that one stings.
it's very expensive, and there's no line item on the P&L that says cost of turnover. It's just hidden. You can't see it. So if you want to increase profits, one of the biggest things to do is keep your people with you for a really long time.
That's a great point. Yeah.
I measure employee turnover as the number one metric. Now we do, accounting, so knowledge workers are hard to find. But in any business, if you keep a team together for a long time, your margins grow. Recruiting and training new employees is extremely expensive. So one of the reasons why you want to get that recruiting and training cost into that above the line for your billable people is because now you can see the cost of turnover. All of a sudden somebody left, my direct labor costs went up, my margins went down. Okay, so now I can see, do I need to invest in onboarding those new people, or what's the exit interview I need to implement in order to figure out why did they leave, and how do I make sure my next best person doesn't walk out the door? We got 8 years ago, I became a client of Insperity for the second time. I'm a long time fan and partner. And, as an accountant, I always looked at my payroll and my people as an expense. Income minus expense equals profits. And there they were, one big line item on the bottom, payroll expense. And my thought process in running the company was, if I want to increase profits, I need to lower expense. So let me pay as little as I can, and let me get the cheapest benefits, and turnover is just the cost of running the business. And when I became that Insperity client, I learned you got to look at your people as an asset. And as an accountant, I understood if you have an asset, you're investing in that asset, right? It's like a stock. I'm investing in a stock. I want to get a dividend out of it. I want to get a return on investment. And by looking at your people as an asset and investing in their training and taking the time to define what are the right kind of people that you need in your company, what's the behaviors that are successful, what are the core values that are successful. If you recruit people right the first time, your turnover goes way down on the back end.
For sure, yeah.
And then if you train them, they're going to stay with you for a long time, because the single biggest reason why people join a company, and the second reason why they leave a company, is lack of training, lack of development opportunities. So
interesting. So not pay.
The pay is a short-term motivator. The number one reason people leave companies is they join a company and they quit a boss. People quit bad bosses. And I see a lot of businesses get stuck. I got a lot of $1 million contractors who are trying to get to that 10 million, or 10 million are trying to get to that 30 million. It's usually the skills of the middle managers. Founders of businesses and leadership in business, the cream rises to the top. People who start their own business have special skills. Michael Gerber's ebook really talks about, you have 3 out of the 4 stools of the business you can have in one person. That's an entrepreneur. Nobody has all 4. Usually the accounting and the back office is the weak part. But the ability then to extend that to managers, project managers in particular, and have them understand what is success, and how do you use your core values to make decisions. That changes everything, because all of a sudden people start to say, okay, I like this place. My boss cares about me, and I have a career here. So that's like one of the biggest ways that you can measure profitability is by measuring turnover. To me, it's the number one measure that I look at. So then the last part is the bottom line, is below the line. I mean, so your gross profit is your income minus cost of goods sold, and your profit is your gross profit minus your overhead. Those are all your below the line costs. They're indirect. The customer did not pay for the sales rep or the marketing agency or your office rent and your IT and your accounting and your HR and your lawyers. That's all overhead. So we recommend you try and convert that to variable as much as possible. And one way to do that is leveraging outsourcing, outsourcing your IT role instead of having a person. Unless you have 50 or more people, then I want one person. And then
Sure.
and those are the only measurements that'll help you get to the bottom, drive your bottom line.
Interesting. Yeah. And I love that you steered the conversation to people, because I think a lot of times, again, when people typically think of these, they think of numbers and they just think of, oh, okay, I've got to work these different levers. But you boil it down to, yeah, if you can just decrease turnover with your team, you look at the cost and your gross margin will go up and bottom line will go up. Are there certain benchmarks that you look for service businesses like the construction space and, for gross margin and profitability, or is it just totally dependent on the specific type of business?
It's industry specific. But the math is pretty much the same. The most important decision every business will make is pricing. And pricing, because that's what helps drive margins, right?
Sure.
Once you're above the line costs, you have those labor costs allocated, and if you use QuickBooks, there's 2 payroll companies that have automated. Intuit Payroll for the desktop, and for desktop and online, Insperity. They also have a link to QuickBooks, which is why we use them. And sorry, I forgot your question. Say that again.
No, you're good. I was just asking if there are benchmarks around gross margin and profitability.
So the math to figure this out is you've got to understand what your overhead costs are and what your target net income is. You start there, right? So let's say you want your round numbers, you're $1 million business and you want to make 10% profit. You work backwards from your overhead to see how much does each one of my jobs need to cover that that percentage of overhead. Meaning, if you've got $300,000 of overhead and you've got 1,000 jobs, every job has to be priced so that your margin's going to cover. You're going to cover your above the line cost plus $3,000 per job. And if you want to make $150,000 of profits and you have 1,000 jobs, you got to add another $150 on every job to get the 150 grand. There's a great book called Profit First.
That's a great one.
You start with how much money do you want to make? Okay, then how much does it cost me just to have the lights on? Now I know how much margin I need on every job. And you work backwards from there to figure out your pricing. Because if you don't price right, you're not going to make the profit. And a lot of business owners think they can sell their way to profits. What matters is not how much you earn, the top line, although it's good for the ego to say, I'm a $6 million home builder or electrician or whatever, but it's how much you keep. To answer your question about metrics, a well-run business is going to be 12 to 15% the bottom line. If you're a market leader, you're going to be 15 to 20%. I got one company right now who's at 12, so they're right at the bottom of the well-run companies. but they want to sell in 3 to 5 years. So they're trying to get to 17 so they can get percent, because they can get into that highest market exit valuation.
Yeah. Get their multiple up.
Exactly.
Yeah.
So,
Well, and I like that. I mean, it really, the way you break it down, starting with the end in mind, and you hear that come up in a lot of different other scenarios, but not necessarily in this, because you just go, oh, I got to sell, and then I'll kind of see what's left over. And it's like, well, not much is going to be left over if you're just kind of seeing how it shakes out. Yeah. Well, and that gives you a strategy for pricing too. I feel like a lot of times people don't have a great strategy behind it, but you're saying, hey, just start at the bottom, add in the overhead, add in, and then you've got a price. And so I'm assuming your answer would be, hey, if you have a customer and you've priced it out according to your end goal, you shouldn't discount, because otherwise you're just working against yourself.
I am so glad you mentioned that. I mean, discounting is the single biggest reason why that businesses struggle with cash flow problems. Because when you give a discount, 100% of the discount you've given comes out of your cash flow, comes out of your bank account. It comes out of your net income. So when you're saying, okay, when you have a 5% or a 6% net income, it's because you're missing that extra 10% on the top line. And to my mind, identify your unique selling proposition. Why are you there? Especially, this company it's an HVAC company I'm talking to, they're in business 86 years. It's like, guys, you have to pay for that experience. That's the value, right? Totally. Yeah. So now you should be a premium buyer. So it'll be an interesting conversation. But
you're not just paying for an hour of their time. You're paying for the years of experience.
And when you invest in your people and you keep your people together for a long time, that's worth a lot. If I know that 5 years from now, the same team who installed my HVAC system is going to come back, then I'm going to pay a lot for that security. So anyway, you mentioned something very powerful, which is start with the end in mind. So what I was a manager of accounting system design at Ernst & Young, and I used their methodology that we used on the Fortune 100, which is, what are the decisions you're trying to make? And there's 5 that we've identified for small businesses. Then what are the drivers of those decisions? And then you figure out, what reports do you need? So the first decision is, where do you spend your time? Where does management spend your time? And we've created a 1-page company scorecard that shows you the 5 most important drivers of the business. Do you have a top line problem? And we do trailing 12 months. If listeners take one thing away from this session, TTM is the only way to see the true economic result of anything.
Interesting.
What it is it's a chart, and with each dot on the chart is the total for the prior 12 months. So for example, if you got a revenue chart, on our revenue chart, the right-hand side, it shows you October 2019. What was the total revenue for the year before that? And then each month it changes. You add another month and it drops off 13 months ago. And if the dot goes up, it means that this month was better than month 13. That's gone. So I can see the economic result of the month. How are we doing? And the reason that's so important is because most small businesses, and the construction industry in particular, do not have degreed accountants on staff. You've got really good full charge bookkeepers who may have the title of controller or accounting manager or finance manager or whatever was necessary to keep Sally in the job, because you can't live without Sally. So if you want to call yourself controller and it doesn't cost me any more money, of course you are a controller. That
nice title bump. Yeah.
Yeah, it makes me look big. But what happens is that person can't manage the month-end close. So the books on a monthly basis are kind of cash basis or modified cash basis. So if you have biweekly payroll, twice a year, you have 3 payrolls. That means twice a year, your biggest expense, more than half, is 50% higher than the other 10 months, because you have a 3rd payroll. You didn't hire any more people. You didn't give anybody raises. But A lot of times I see business, they say, oh, they have a loss. It's like, what happened here and there? Oh, that's a 3 payroll month. We always lose money on those months. What basic accounting does is you say, I suggest you switch to semi-monthly, just adding 2 or 3 days to a payroll. And then now all of a sudden you got one number on the 50th of the month. You record that last month, you got payroll in the right month. That's big. You have to,
that's interesting.
The management accounting is about the matching principle. Every month you match the income and the expenses that were incurred to earn that income in that month. And you only need to do 2 things. You need to get the income right. So at the end of the month, you do accrual that says, okay, how much revenue did we earn? These jobs that are not complete. QuickBooks, what's great, you can go into the projects tab and you can turn on and say active project or inactive project. And then the bookkeeper just goes and says, whatever the active projects are, dump that into Excel, send it out to the field. What percentage complete are you on that job? I'm going to recognize revenue as the percentage of complete for this month, even though we're not going to bill it next month, but our people earned that income. So we do a reversing entry to recognize 80% of it in this month. And then on the first of next month, it'll reverse it out. It'll make it negative 80 next month, so that when I send the bill out for 100, I'm only recognizing 20,000 next month when we finish the job. If you do those 2 things, you get payroll right in the right period, and you recognize revenue when it's earned. Now you can look at a P&L each month and see it. If you don't do these things, trailing 12 months will smooth out all those errors. It'll average out over 2 years that those 3-month payrolls, 3 payrolls a month, it's a 2-year trend. So it tells you really what's going on. So revenue is where most people start. What we look at is the next row is the gross profit dollars and the gross profit percent. So those are your drivers number 2 and 3. And you're looking there to see, whatever's changing in your revenue, if your revenue is going up, are you maintaining your gross profit percentage? Because a lot of times businesses grow, you're probably experiencing in your business, right? It's booming. So as you start adding people, your margins start to erode, and you got to watch that. And then the third is the bottom line, is the net income dollars and net income percentage. If you watch those 5 things, it tells you, where do you spend your time? Do I have a top line problem? Do I have an above the line problem? Or do I have a below the line problem? I often see companies that are growing their top line, their revenue, they're growing their margins, and then but their net income is going the opposite way. Why? Because they're investing in sales and marketing and it's not working. Their overhead, their below the line costs are not generating an ROI. So that's a powerful thing, to be able to separate out the trend of your gross profit from your net income, because that's how you get visibility into the performance of those below the line costs.
Yeah, that's great. That I've never heard a couple of things in there. The trailing 12 months as just a different, you just typically get into a rhythm. You look at 2019, 2020, you just kind of look at that, annual snapshot. And then we do payroll weekly. And so for us, there's 4 months out of the year where there's a 5-week payroll month, so just right, like you're describing. So yeah.
Weekly is not bad, because if you do it weekly, what I would suggest though is, when the bookkeeper is recording that weekly payroll at the end of the month, just have her break it into 2 parts. First 3 days is this month, the next 2 days is last month. So once a month, she just has to make one simple adjustment. Bi-weekly is where you have a problem, because it's just every other week just causes accounting challenges.
Yeah. No, that's a good point. Well, I've got a good action item out of this too for myself. So Steven, I know we're getting a little close to time, but I know you wanted to share a couple of things on cash flow too, as we get here to the end.
Yeah, I just know what, we're seeing our clients are dealing with right now, and cash is king. And, the first way to increase cash flow is to get pricing right, because cash flow comes from margins. The reason why gross profit percentage is the most important number on the spreadsheet is because that's what creates the cash to cover your overhead, and if you generate enough to give you that free cash flow. Whether it's good times or in bad, the best practices around cash flow is just about managing the timing, when money flows in and when it flows out. And the first way to do that is with a cash flow forecast. And we've got a cash flow forecast tool that I'll
Yeah, we can put that in the show notes if you send that my way.
I'm making a note right there to
Cool.
give that away. And what it does is it allows you to be able to take your QuickBooks receivables and dump them into Excel, and then suck it into this template, that Excel template that allows you then just to have to enter what week do you expect to collect on all those balances, week 1 through 13. And that you don't have to type in all the customer names, and it shows you the aging, what month it was, what month it's due, and all the summary information right out of an aged AR. But now you can forecast when do you expect to collect on that. And we recommend 13-week cash flow because you need that much time to see if you have a problem. Then you do the same thing with your payables. You take your aged accounts payable report, dump it into Excel, suck it into the template, and write down 1 through 13, when are you going to pay those bills? And it brings that onto a summary, sources and uses of cash flow. And then you can add anything else that you want, like stuff that's not in receivables. You're gonna get a big deposit check from a customer. You're gonna get a loan from the bank. Anything else that might be a source of funds. And then the same thing at the bottom. You add anything that's not in accounts payable. Any other uses of funds, like your rent, or you got to pay down a credit card. And then you can see real easy how much cash you've got. Once you know that, then the second step is to focus on collections. And there's some basic best practices around collections that I think is helpful for people to know. You want to be firm, focused, and friendly. 3 F's of collection.
Yeah.
And what firm means is you want to get a payment date or a next call date. No matter what, you don't get off the phone. It's like, okay, you owe us money. I need to know when we're going to be able to talk about getting the second half. So how's Monday at 3? No, I'm not going away. You owe us money, and we're not a bank. Second is you want to be friendly, because you get more from honey than you do with, well, whatever it is, vinegar.
Yeah, vinegar. Yeah, absolutely.
But the focus is really the key. You have to train the people who are making the phone calls. And, it's usually the receptionist or the office manager or somebody who does not want to do it. Therefore, it usually doesn't get done until it's urgent. But you have to make sure that they are trained to overcome objections, just like a salesperson. Before the customer gives you an objection, you know how to overcome it.
That's
The first is the check is in the mail, right? I mailed it. Yep, I just sent it out this morning. Okay, great. QuickBooks Payment Solutions has the ability to make a deposit without the actual check, just the check info. So you can go enter the check number and the date and the amount and the customer's bank account information, and you'll be able to make an ACH debit. So even if you don't sign up for that service, ask them, okay, great. I want to just, put it in my records. Please give me the check number, the amount, the date, and make sure you make them at least go through the exercise of lying to you. But usually what happens is when they have to go get a check number, they might as well pull the checkbook out and write the damn check.
Yeah, no, I like that. That's a great strategy.
The second objection is, I can pay you half. I'll give you half now. I got a little bit of cash flow problems. It's like, okay, no problem. This is the time, if you have customers who are struggling, and they shouldn't be because this industry is on fire, then now is a good time to take credit cards. And Intuit Payment Solutions has this, and we don't get paid anything for recommending these guys. It's just magic to automate the billing, the collection, and the actual bookkeeping to apply the payment against the outstanding accounts receivable. Customer gets an email that says, pay now. You enter in your credit, they enter in their credit card number. It goes and gets settled through Intuit Merchant Services. 48 hours, you get an email with an attachment showing you what your payments were. When you open the attachment, it updates your QuickBooks desktop. If you're on QuickBooks Online, it'll automatically update. So it knows if your customer has paid you. And if your customer hasn't paid you, it knows to send a reminder email as often as you want. So we set them up for Sundays. Sundays is a magic day in collections. I got to be an Inc. 500 conference featured speaker for a couple of years. And to do that gig, I did a survey of the Fortune 1000 companies' best practices in cash flow. And I learned a couple of really cool things. Number one is invoices that get sent on the weekends get paid a full 10 days earlier than invoices that go out on Tuesdays, Thursdays, and Fridays.
That's crazy. Interesting.
Why? Why? I looked into it. I read it. Because the person who's paying the bills thinks, oh, they did this on the weekend. They must be serious about getting paid. I'll respect them and I will take care of this right now.
That's interesting.
Fascinating, right?
Psychology is so interesting.
Yes. Yeah. So what it's also nice though is that because the payment into a payment services is linked to your QuickBooks file, it knows if your customer hasn't paid you, and you can get progressively more aggressive. I like a tool called Funding Gates. Only works with QuickBooks Online. It's an accounts receivable portal that helps you manage your receivables and give you alerts to say, hey, we've sent 4 emails, we've made 3 phone calls, and this person hasn't responded. And now, as you as the CEO or business owner, you need to focus on these 6 customers. That's great. Pretty powerful. Yeah, Funding Gates is awesome. And then, the last one is we can't pay anyone right now. We're really stuck. This is when you definitely want to use the credit card because you want to shift the risk to MasterCard and Visa of non-collection. Mm-hmm. That insurance is gold. So you should open up the credit card and make sure if somebody's really struggling, pay the 2.5% to 3.5%. It's much, much cheaper than paying staff to chase them down and obviously a default.
Yeah, that's a great point.
The other big thing we're suggesting clients do now is you gotta not let your clients' cash flow problems become your cash flow problems. So it means making sure that your contracts, that you update the credit policy, and you want to make sure that the payment terms are really clear. When is this due? And what we suggest is you include who's the person paying the bills, and when do they pay those bills, so that we get an agreement about when you will have payment by. You want to do that before you start any work when they love you, because then you have an ability to go after them. You want to make sure that late fees are really clear. Say, what are they? And when do they start accruing? We recommend you should be 18% interest rate right now. What that is it's 1.5% per month. So 18% a year. And if somebody's late, you immediately add that late fee. Why? Because it gets you to the top of the pile.
Yep.
A good controller is managing cash flow, and they're looking at their bills and they're looking at the interest rates. Their bank expensive debt gets paid right after the credit card gets paid. And then, they're managing the cash flow to the stuff that doesn't have any late fees. I'm going to put that to the last because at least I'm not digging a deeper hole, because interest rates will kill you. So, that's one of the ways that you don't let your clients' cash flow problems become your cash flow problems. And then if you can't get paid, you want to make sure that your credit policy and your contract spell out who will pay the attorney fees.
Mm-hmm.
So if you have to go to court, you'll get it. So those are kind of my best practices on the collection side. The bill payment is one big one, which is Bill.com. I've been doing outsourced bookkeeping, accounting, and controller services for companies that use QuickBooks, Xero, NetSuite since 1995, and we used to do things manually when Netscape 1.0 came out, and the Bill.com helps you automate the entire bill payment process. So you can pay your bills on your phone and manage workflows that let you manage your cash flow. You can, ACH payment anybody and pay them 48 hours before they need to have the cash in their bank. So you can pay as late as possible. and it reduced the cost of us processing bill payments for our clients from $12.50 to $1.58.
Wow.
And you have a scanned image attached. We caught a bookkeeper. Desperate times create desperate people, and high unemployment is not good for small businesses, because fraud for us is much higher than big business, much higher, because we don't have separation of duties. There's nobody watching the bank account. And the Bill.com helps you reduce that risk, because you can see a scanned image of every bill. We had one poor mom whose husband lost his job. The kids were streaming Tiger Kings on their iPads, and they didn't have an unlimited data plan. She submitted a $655 AT&T bill along with the company's AT&T bill. And normally the business owner would have just seen two different checks at the different times of the month and not realized that he paid it twice. And he could see the invoice was not his. So we're a big fan of Bill.com. I've got a good blog on that on our growthforce.com website.
Cool. Yeah. And I know we're running out of time here. I do have one last segment of the show for us, but Stephen, this has been really insightful, good stuff. I think kind of a fresh take on some of the numbers that you often get. If people want to learn more about you and your company and how you guys help, what's a good way to get in touch or learn more?
Yeah. So growthforce.com is our website. GROWTH force.com. And we've got a blog there, and I've got a podcast. You can email me any questions at Stephen with PH, STEPHEN at growthforce.com, or I'm on social as Stephen King CPA. LinkedIn is, we're pretty active there, so you can ask questions as well. Stephen PH King CPA.
Cool. Yeah. And for everybody listening, we'll drop all those in the show notes, make it easy for you guys to get over to Stephen and Growth Force, and definitely recommend you checking them out and seeing what they're up to. Stephen, I got a few more questions for you. This is called the Fast Five. So I'm going to hit you with 5 rapid fire questions. Just say whatever comes to mind. First question is, what's your favorite business book and why?
E-Myth, Michael Gerber. He said that every business, there's a myth in America that if you start a business, you will be rich.
Yeah, for sure.
And to me, that was one of the most painful lessons I had when I had my CPA firm in the 80s. That how many business owners, especially in the construction industry, struggled. They don't live that dream. They don't have 12 to 15 or 20% profit. They have cash flow problems and 6 to 8%. Because they only have 6 to 8% margins. And what he said was, there's 4 legs to the stool: product, sales, service, and back office. Do the 3 that you're really good at and outsource the last one. Don't worry about it. Find the best in the business and be that. And that's when we started Growth Force. I read that book. I was like, okay, that's what Growth Force is going to be. That 4th leg of the stool.
Very cool. Very cool. All right. Next question is, who is the most inspirational person in your life?
Alive or dead?
Your choice. Yeah, your choice.
The most inspirational person. I have to say, I think right now it's probably Jack Healy from Amnesty International. I was the CFO of Amnesty International 2 weeks after Bruce Springsteen and U2 and Peter Gabriel finished the Human Rights Now tour, and Amnesty grew from $6 million to $18 million, and I had to handle all the money. So I've been thinking a lot about Jack now, because we do 35% of our business is nonprofits. We apply the same principles, except to fundraising. How much does it cost to put a kid on a bus to their vocational training? That's what the donor gets. I was the director of development and CFO of Amnesty, so I know a lot about that. So Jack Healy, cool. I'd have to say Jack.
That's awesome. Jack. That's awesome. If you're listening, hey, Jack. If you could have one superpower, what would that be?
Oh, wow. I'm in an office that's filled with a lot of geeks, and so there's a lot of spidey sense going on in our business.
Nice.
I would say my superpower would be to not have to sleep, so I could keep working, because I love what I do so much. I have to force myself to go do my garden, be with my friends and play. kids.
That's awesome. Well, I can definitely tell just your energy through this discussion. So that's cool. All right. Describe yourself in 3 words.
Fun, happy, loving.
All right. Final question. If you could leave our listeners with one piece of advice, what would that be?
You need both a human capital strategy and a financial management strategy to run better, grow faster, and make more money. It's people that drive profits, whether they're subs or staff, and you have to see the profitability on the people in order to and have the ability to create a culture that drives more productivity and more discretionary effort and all the tricks that come around with goal setting and alignment of all that and rewards and recognition. I would say you got to do both, and that's why I love our partnership with Insperity, because they do the HR side and we do the financial management side.
Very cool. Very cool. Well, Stephen, I really appreciate you spending the time with me. This was great. And I know I've got a few action items that I pulled out of it for myself as well. So thanks for joining me today.
My pleasure, buddy.